Hello everyone, I am Dr. Soundararaj. I am very happy to interact with you all through this video. In this video, I am going to teach you the calculation of payback period, discounted payback period, net present value and IRR for a particular project. These are all a couple of details related to my career. After you watch the full video, if you find the video useful to you, give a like to the video. Kindly subscribe my YouTube channel and enable the notification so that you will get the notifications of my new videos on commerce and management topics. Let's get into the problem. A company is considering a proposal of installing a drying equipment. The equipment would involve a cash outlay of 9 lakh rupees and a net working capital of 1,20,000 rupees. Altogether, the cash outflow on this project would be 10,20,000 rupees. The expected life of the project is 5 years without any salvage value. At the end of the economic life of the equipment, that's nothing but at the end of 5 years, the company will get nothing at the disposal of the equipment. Assume that the company is allowed to charge depreciation on straight line basis for income tax purposes. See, of course, the total capital outlay on the project is 10,20,000. The depreciable value of the project is only 9 lakh. This 1,20,000 which is going to be introduced in the beginning of the project will come back to us at the end of the project as it is. Whereas this 9 lakh rupees invested will not come back in monetary form. Perhaps this would be depreciated throughout the lifetime of the equipment. That is why the 9 lakh rupees is called as depreciable value of the asset. The estimated before tax cash inflows, that means the cash inflows which are given down here are before tax. So you are given with the profit before tax of the equipment for the 5 years. That's the economic life of the equipment. So before tax cash inflows in thousands are given 360, 412.5, 315, 270, 240. The applicable income tax rate to the company is 35%. If the company's opportunity cost of capital is 12%, calculate the equipment's payback period, discounted payback period, NPV and IRR. So in the problem, the tax rate is 35%, the discount rate is 12%. We are asked to calculate payback period under traditional method, then discounted payback period, NPV and IRR of the drying equipment. Let's get into the calculation. Statement showing cash flow after tax. That means we are going to find out the cash inflow from the project, which is otherwise known as profit after taxation but before depreciation. We are given with the profit before tax as per the problem. So that are presented here in the first row. From that we deduct depreciation. How depreciation is calculated? Depreciable value of the asset 9 lakh divided by lifetime 5 years. It gives us 1,80,000 rupees depreciation per annum. That is subtracted from every year's profit before depreciation. Then we calculate profit before tax for all the 5 years. Fine. Then from the profit before tax, we calculate tax at 35% and that is deducted here in this stage. Followed by we calculate profit after tax. It comes to 1,17,000 for first year, second year 1,51,125, for third year 87,750, for fourth year 58,500, for fifth year 39,000. Now to calculate the cash inflow from the project, we have to add back the depreciation with the profit after tax. That is what done in this stage. In addition to adding depreciation with the profit after tax, we should also add the working capital which will be released back by the project at the end of its lifetime. That is at the end of 5th year. So the 1,20,000 which will be invested in the beginning of the project will come back as it is because it is a money related to working capital. Now let us total these figures. For the first year, the cash inflow of the project comes to 2,97,000. For second year, the cash inflow comes to 3,31,125. Third year, it comes to 2,67,750. For fourth year, it comes to 2,38,500. And for the final year, it comes to 3,39,000 rupees. Now let us calculate the payback period under traditional method and payback period as per discounted cash flow method. Now the cash inflows of the project just calculated are presented here in this column. Now cumulative cash inflow is done in the third column. Why we go for cumulative cash inflow calculation? Here you find the cash inflows of the project are not uniform for the 5 years. That's why we go for cumulative cash inflow calculation. First year, the cumulative cash inflow comes to 2,97,000. Second year, it becomes 6,28,125. How it becomes 6,28,125? 2,97,000 plus 3,31,125 gives us this figure. And the third year cumulative cash inflow, how it is computed? 6,28,125 plus 2,67,750 gives us 8,95,875. So similar calculation is done for fourth year and fifth year, and final cumulative cash inflow from the project comes to 14,73,375. Now to calculate the discounted payback period, let us go for finding out the PVIF factors at 12%. Look at the PVIF table at 12%. For first year it gives us 0.893, for second year it gives us 0.797, third year 0.712, fourth year 0.636 and the fifth year 0.567. Those PVIF values are presented here in this column. Now present value of cash inflows are calculated according to this column. 2,97,000 into 0.893 gives us 2,65,221. 3,31,125 into 0.797 gives 2,63,907. We are multiplying the cash inflows with the PV factors for each year. 2,67,750 into 0.712 gives us 1,90,638. For fourth year, 2,38,500 into 0.636 gives us 1,51,686. For fifth year, 3,39,000 into 0.567, it gives us 1,92,213. Now, if you total these values, you get 10,63,663 as a total present value of cash inflows of the project. This would be useful for calculating NPV. Now let us go to calculate the cumulative of the present value of cash inflows, which is required for calculating discounted payback period. 2,65,221 plus 2,63,907 gives us 5,29,128. 5,29,128 plus 1,90,638 gives us 7,19,766. You add 1,51,686. It gives us 8,71,452. You add 1,92,213 with that, you get the final figure of 10,63,665. This is the total cumulative present value of cash inflows of the project. Now let us here complete our calculation of NPV and then move to calculate the payback period and the discounted payback period of the project. Now total of the present value of cash inflows of the project is 10,63,663 minus present value of cash outflows comes to 10,20,000. How? 9 lakh rupees is the purchase value of the equipment plus 1,20,000 its working capital put together 10,20,000. Now the difference comes to 43,665 positive NPV. Now let's calculate payback period. The initial investment comes to 10,20,000. Now look at it. Till the end of third year, we are able to get back 8,95,875. See, as far as this calculation is concerned, within 3 years, we were able to get back 8,95,875. We depend upon the fourth year cash inflow to recover the balance of 1,24,125. Now we do the calculation. 12 months related to the fourth year divided by 2,38,500 cash inflow of the fourth year into 1,24,125, the balance of investment to be recovered in the fourth year, it gives us 6.24 months, approximately 189 days in the fourth year you need to spend to get back the balance of 1,24,125 of your investment. So altogether, your payback period will be 3 years and 189 days or 3 years and 7 months approximately. Now computation of discounted payback period. Till the end of 4th year, we are able to get back 8,71,452 rupees of our investment as per discounted payback period. Let's look at the calculation. So we have taken 4 years to get back 8,71,452 of our investment. The remaining amount of investment, which comes to 1,48,548, to be recovered in the 5th year. How this 1,48,548 is calculated? 10,20,000 minus 8,71,452 will give us 1,48,548. So we wait for some time in the 5th year to get back the balance of our investment amounted 1,48,548. Let's do the calculation. In the 5th year, the discounted cash inflow of the project is 1,92,213. Now look at it. We wait for 12 months in the 5th year to earn 1,92,213 rupees. Therefore, in the 5th year, how long we should wait to get our balance of investment amounted 1,48,548. So we need to spend 9.27 months in the 5th year to get this balance. So altogether, the discounted payback period of the project comes to 4 years and 9.27 months, or you can say 4 years and 10 months approximately. Now computation of internal rate of return. At 12%, when we calculated the present values of cash inflows of this equipment, it came with a value higher than the target investment 10,20,000. Therefore, we should try a higher percentage to get our internal rate of return for the project. Yes, that is why they have tried 14%. Now, when they tried 14%, they have multiplied the cash inflows of the project with the respective PVIF factors which have been chosen from table number 1 titled PVIF. For 14%, they have chosen the values and presented here. They are multiplied and they have calculated the present value of cash inflows of the project at 14%. In total comes to 10,12,968. Now, if you deduct the investment made on the project in total 10,20,000, the answer is what? Minus 7,032. One total present value is less than the target value 10,20,000. The other total present value at other percentage, that means at 12% is higher than our target value 10,20,000. Therefore, we are ready for interpolation between 12 and 14% to come to know the exact IRR for this project. Now let's look at the calculation of IRR. The lower rate among the two, 12% and 14%, is 12%. Positive NPV at this rate, the lesser rate which is written here, so it is 43,665 divided by difference between the total present values of the two rates. At 12%, 10,63,665. At 14%, 10,12,968. That we have written here as the denominator. Into difference between the two rates, we have tried under trial and error method. 14 and 12. The difference between the two is 2%. And outside the bracket, you write percentage symbol for easy calculation. If you simplify this, you get 1.72% of this second calculation. In total, the IRR for the project comes to 13.72%. Fine. As per IRR method, this project is accepted because the IRR of the project 13.72 is higher than its cost of capital of 12%. According to NPV, this project could be accepted because it has got positive NPV at the cost of capital of 12%. Then regarding payback period, if they give you the cutoff payback period, you can decide whether the project could be accepted as per traditional payback period and also as per the discounted payback period. Since we do not know the recommended or cutoff payback period for the business, we are unable to come to a conclusion based on the results of traditional payback period method and discounted payback period method. We simply leave the answer by calculating the payback period of 3 years and 7 months under traditional method, then 4 years and 10 months under discounted payback period method. I hope I have done my lecture in a detailed way up to your level of understanding. Kindly watch this video for a couple of times to understand this exercise thoroughly. Thanks for watching this video. I'll meet you in another video. Bye for now, everyone.